Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. In this video, we'll cover Chapter 12, Comparative Forms of Doing Business from Corporations, Partnerships, Estates, and Trusts, 2026, the 49th edition. By the end of this chapter, you should be able to identify the principal legal and tax forms for conducting a business. We'll explain the relevance of non-tax factors in making business entity decisions. We'll distinguish between the forms for conducting a business according to whether they are subject to single taxation or double taxation. We'll identify techniques for avoiding double taxation and for controlling the entity tax. We'll identify the influence of the conduit and entity approaches on the tax consequences of an entity's operations and the effect that it has on its owners. We'll also analyze the effect of the disposition of a business on the owners and the entity for each of the various business entity forms. And lastly, we'll compare some of the key tax rules for the various forms of doing businesses. So the first decision that every entrepreneur needs to make, it's not necessarily their logo or the business name or their Instagram handle. It's ultimately going to be their business form. Are they going to be a sole proprietorship, an LLC, an S corporation, or C corporation rather? Are they going to be a partnership? So these choices, as we're going to come to learn by the end of this chapter, these choices shape everything. It's going to impact their taxes, their liability, even whether or not investors are going to take their business seriously. So just a quick fun fact, according to the U.S. Small Business Administration, the SBA, over 80% of businesses, they start as sole proprietorships, which we're going to learn a bit more in the next few slides. But most businesses, they'll eventually convert to either an LLC or corporations as they grow. So as it relates to doing business, again, yes, individuals, entrepreneurs, they think about what are the tax consequences of forming this business, but there are also some non-tax factors that they also need to consider. So with effective tax planning, this requires an understanding of how these factors are going to impact the tax and non-tax consequences of common business transactions, not just for the business itself, but also for the owners, and also how those consequences, how they differ across the various legal and tax business forms available. So as an accountant, this is one of the benefits, the value that you can provide to clients, right? Consultation before they decide to form this business. Typically, they'll reach out to a CPA or to an enrolled agent or an accountant, and they'll ask them these questions. Hey, what are the pros and what are the cons of me registering the business as a sole proprietorship versus an LLC? So in certain cases, sometimes, there's legality behind it. You need to file certain forms with the state. In addition, sometimes there's administrative burdens. Sometimes there are tax pros, tax cons. So all of these things ultimately need to be considered. So the principal forms of doing business, as mentioned, we have the sole proprietorship, the partnership, the LLC, the C corporation, as well as the S corporation. And we are going to get or go into a bit more detail about these various forms of doing business. There's also nonprofits, which is not going to be covered in this chapter. There's also trusts and estates, which are going to be covered in a later chapter. There's also a new form of doing business, which is a B corporation. And basically just think of it as a hybrid of a C corporation and a nonprofit, kind of sort of just in one. So we start off with Unit 1, organizational forms in which businesses may be conducted. So generally, the state law, they use one of two perspectives when they define the rights and the responsibilities of a business entity. So we have what's called the conduit perspective, and we have what's called the entity perspective. So conduit perspective, in its simplest form, a conduit or aggregate perspective, it treats the business as simply an aggregation of its owners joined together in an agency relationship. And then it says, under the strictest interpretation of the conduit perspective, the business is viewed as merely an extension of its owners, right? I like the second bullet point a bit better. The first bullet point is, filled with a lot of jargon, but the second second one makes it, simple, right? Simply stated, the business is essentially just an extension of its owners, ultimately. Then next we have what's called the entity perspective, and this considers the business as separate and distinct from its owners with its own rights and responsibilities. So this ultimately depends on the type of business structure, because if you are a sole proprietorship, you fall under the conduit perspective. So in the event, you form this sole proprietorship and you were sued, if the business has no money, they can come after the individual personally. So that is the conduit perspective. The sole proprietorship is essentially just an extension of the individual that owns it. An entity perspective, this will apply to a corporation, right? A corporation is a totally separate and distinct entity. The corporation can enter into contracts. The corporation, can purchase buildings and things of that nature. So corporations would fall under the entity perspective. Next, we have what's called rights and responsibilities that are afforded to corporations. Oftentimes, consistently they'll reflect the entity perspective, that the business itself, as mentioned, they can operate, for lack of a better word, as though they are an individual. So a corporation, as mentioned, is a separate legal entity. It has the following characteristics: continuity of life. If you have a sole proprietorship and the business owner dies, guess what? The business dies as well. With a C corporation, even if the individual that started the corporation dies, it does not mean that the corporation dies. So long as, there are individuals in place to keep the vision going, the corporation continues to exist. There's centralized management. There's free transferability of interest. For a corporation, you purchase stocks to have ownership in the corporation and you could sell them, right? We have day traders and, people that they purchase stocks and they decide, hey, you know what, the market is up, I want to sell it right now. There's not a big hassle versus if you have an LLC, a partnership and things of that nature. And then also with the corporation, it has limited liability. So with limited partnerships, this treats all partners much like shareholders in a corporation. There's no ability to participate in the management of the partnership, and their limited liability is to the extent of their investment in the entity. So there must be at least one general partner. So this is typically, one of the downsides of a partnership, because in the event that, let's say, myself and another individual, we form a partnership and my partner makes a bad business deal, unfortunately, if the business has no money and my partner has no money, they're going to come after me and my personal assets in order to, recoup. But the benefit of that, the limited partnership, is that as it states here, it's limited to my investment in the entity. There must be at least one general partner. So that one general partner, basically think of them as a scapegoat pretty much, right? They're going to take the fall. That general partner takes on full responsibility, full liability rather. Next, we have what's called a limited liability partnership. So this provides all partners protection from partnership liabilities, but only those liabilities that arise from the acts of negligence, fraud, or malpractice. So typically, this applies to like doctors and professionals that come together, CPAs. They might put together a limited liability partnership because in the event that, we'll use the same example, and my partner made a bad business deal, he committed fraud. In such case, even though we have a partnership, I'm not going to be held liable for it. So partners continue to be liable for the contractual liabilities of the partnership. So as we can see, and we haven't even covered all the slides thus far, there's a lot of nuance regarding the form of business. So there's a lot that goes into it. Similar to the shareholders of a corporation, all members are shielded from all of the entity's liabilities. So just a few things to keep in mind. Depending on the form of business, you might hear different terminology. When we're dealing with a sole proprietorship, you'll hear owner. When we're dealing with a partnership, you'll hear partner. When we're dealing with an S corporation or a C corporation, you'll hear shareholder. And when you're dealing with LLCs, you'll hear members. Even though the terminology is different, it basically means the same thing, right? Ultimately, it represents those who have ownership within the company. So please do not get, confused by the terminology. It ultimately means the same thing. It just changes depending on the form of business. So it says provide the same liability protection of a corporation, but they typically lack one or more other corporate characteristics. So it's a combination and extent of these other characteristics that afford LLCs differ. It depends on the state in which the LLC is organized. So ultimately, all depends. Then we have organization forms are recognized for, federal income tax purposes as well. The tax treatment of the business is generally determined by the legal form in which the business is conducted. So if you are a sole proprietorship, for tax purposes, you're going to be treated as a sole proprietorship. You file Schedule C as in cat on your federal tax return. But there is an exception. We have what's called the check the box regulations. So this is why typically most business advisors, tax professionals, we would suggest that clients start off as an LLC because there's a great level of flexibility. With the check the box regulations, this provides for most unincorporated business entities, including LLCs, they can either be disregarded or they can be treated as partnerships for tax purposes depending on the number of owners. So we have what's called a single member LLC, which is the equivalent of a sole proprietorship. And the only difference is that you get limited liability. That is a single member LLC. In such case, when they are treated as disregarded, they file Schedule C. When we have what's called a multi-member LLC, this is where there are two or more members, two or more owners. In such case, they are treated as a partnership. So they would file Form 1065. And again, it ultimately depends on the number of owners. One owner, single member, two or more, multi-member. Regulations, they allow most unincorporated entities to elect to be treated as corporations for federal income tax purposes. So your form of business remains the same. However, you can elect to be treated differently for tax purposes. An entity may be taxed as a corporation even though it's not organized as such under state law. Again, so there are some levels of, flexibility. A corporation, they can elect to be treated as an S corporation for tax purposes. The income of an S corporation is passed through, is treated similarly to that of a partnership. The designation, it has no effect on a corporation for state law purposes. It's only relevant for tax purposes. So you want to keep that in mind. And then limited partners, they have similar liability protection as shareholders in a corporation, provides limited partnerships much the same ability to raise capital as corporations. So that's one of the benefits of the S corporation. In some instances, limited partnerships, they've registered their interest on established securities exchange. So like the SEC, publicly traded partnerships, PTP, they're treated as a corporation for tax purposes. And this allows these limited partnerships that derive pretty much all of their revenue from investments and natural resources. They can be treated as partnerships even if the partnership interests are publicly traded. So this just covers, some of the main organizational forms in which businesses can be conducted. And I'm just going to scale back a few slides because, again, these are the various forms. Sole proprietorship, you wake up one morning and you decide, hey, I want to start a business. You do not need to file anything formally with the state, right? So think of these forms of business like vehicles, right? Sole proprietorship is like a bicycle. It's cheap, it's easy, no airbags, right? Next, you have a partnership. You and someone else, you guys decide, hey, we want to get into business. It's like a tandem bike, right? You pedal together, but in the event that, one person stops pedaling or the other one, tries to, pedal backwards, then it's going to become risky, right? Now you are exposed to more risk based on the decisions that your partner makes. Then we have an LLC. Think of it like an SUV, right? There's balance, protection, you have flexibility. Then we have an S corporation, right? It's a hybrid car. It's efficient, but there's a lot of restrictions. And we live in this day and age where there's lots of information that is on social media. There's a lot of people that say, hey, form an S corporation, you'll save money on taxes. That is true, right? But again, as we're going to learn in this chapter, it's not just about tax considerations because now there's more of an administrative burden. The S corporation, the owner members, right? The shareholders or shareholder owners rather, now they need to file payroll. They're also going to be filing rather a separate tax return, the 1120S. There's also some nuance that if there's more than one shareholder, Distributions need to be in proportion to the level of ownership. So there's like so many things that need to be considered. Saving money on taxes is not the only thing to think about. And then lastly, with the C corporation, it's like a big commercial truck. It's powerful, but it's expensive to run. There's a lot of things to consider. All right. So we're going to move on to unit 2, the non-tax factors that affect the choice of organizational form. So with the sole proprietorship, again, unlimited liability. Let's say you start a restaurant, you love to cook, and unfortunately, someone comes in, they are allergic, or they just got sick from the food, and they decide, hey, I am going to sue your business. They sue the business is brand new, doesn't really have any money. Unfortunately, the owner of the sole proprietorship, the business has no money, they're going to come after the individual personally for their assets. Next, we have a partnership. Again, 2 or more people. That's the only difference between a sole proprietorship and a partnership, is that there are 2 or more people in a partnership. The general partners, those are the individuals that are going to be jointly and severally liable. Limited partners, however, they're going to be limited to their investment. So for those of you that, you're considering getting into partnership with someone, you want to really figure out, am I a general partner or a limited partner? Because when we think about it, there are individuals who start businesses with their spouses, with family members, all of these things. But think of it like a relationship, right? When you start off in a relationship, everything is amazing. You guys never argue, you agree on everything, it's like amazing. But time goes on and arguments start to arise. There are disagreements. You guys can't seem to agree on anything. So with a partnership, it is recommended. It is, I would say, a requirement to put together a partnership agreement. Hey, in the event that there's a disagreement, this is how it is going to be resolved. In the event that we want to admit a party or admit a partner, a new partner into the partnership, this is how it's going to work. Because unfortunately, let's say, I start a partnership with someone and I do 70% of the work, they only do 30% of the work. If we go to court and there's no agreement in place, everything is 50-50, unfortunately. All right. So it is very, very, very important to have things in black and white. Think about the partnership agreement like a prenup in the marriage, right? It basically lets you know, hey, if things don't work out, this is how it's going to go down. Then we have the S corporation. They generally have limited liability. And then same thing with the C corporation. Again, there are, more nuances. We're just covering it surface level for the most part. Some other non-tax factors: the estimated life of the business, the number of owners and their roles in management of the business. Because what we're learning with an S corporations are limited to the number of shareholders. There's freedom of choice in transferring ownership interests. Organizational formality: what are the related costs and the extent of government regulation? What's the ease of increasing equity back by admitting new owners? So before individuals decide which form of business, these are all of the things that they need to consider as they are preparing to decide the form of business. So capital formation, obviously, when you're starting a business by yourself, it could be a little tight, because a lot of times you are relying on your personal, finances to fund the business. In most cases, some people, they are blessed to have family members, friends that are willing to support their business. A lot of people are not, right? And that's the reality. Partnership, you can raise funds through pooling of owner resources. So think of it like this, right? You want to purchase a house. For the most part, if you are a single individual, it's just your income. Versus if a group of individuals come together to purchase a house, right? You guys are pooling together your resources. It makes it a little easier. And there's limited partnership. They can raise capital from investors, so that's one of the benefits with a partnership. And not to say obviously you can't raise capital with a sole proprietorship, but it is very limited for the most part. Next, we have the S corporation. They have the greatest ease and potential for raising capital, but again, there's a limited number of investors, and the investors need to be U.S. citizens. So with the S corporation, the maximum number of investors is 100. And again, the caveat with that is they need to be U.S. citizens. C corporation have the greatest ease and potential for raising capital. There's no limitation on the number of investors. They do not need to strictly be U.S. citizens. So again, all of these things that we factor in. So we move on to unit 3, single versus double taxation. So this is where we, start to think about the numbers. These are some things that people do want to think about. You do, because ultimately, just about a majority of every decision that we're make, there's gonna have some impact. Uncle Sam is gonna be involved to some extent, and depending on the state that you live in, there's also going to be some impact there. So with a sole proprietorship, there's a single level of taxation. What that simply means is that I have my sole proprietorship. When it is time for me to file my tax return for myself individually, as well as my business, I'll file my federal Form 1040, and then I will simply attach a Schedule C, which lists my profit and my loss from my business. Easy, 1, 2, 3. Pretty simple, straightforward for the most part. Partnership, there's also a single taxation, but what simply happens is that each partner, they receive a form 1065K1, and it lists all of their income, their expenses, their deductions and credits. So let's say, I have my partnership, the income was $10,000 and I am a 50% owner. Then in such case, my K1 is going to show $5,000 worth of income, my 50% share. And then for my partner, it's also going to show $5,000. So we each report the $5,000 allocated proportionately on our individual tax return. The partnership itself does not file taxes. Form 1065, it's essentially an informational return that basically just shows the whole picture. And then the K1 only shows, the allocation to the partners based on their percentage of ownership. Well, let me rephrase that. Not based on a percentage of ownership, but essentially based on how much was distributed for the year, or how profits and losses are going to be allocated. Because that's one of the benefits of a partnership. Again, with the S corporation, if you have 50% ownership, you must receive 50% of the distributions. However, with a partnership, using the example that I mentioned earlier, even though we have 50-50 ownership, I do more work this year, based on my availability or whatever it is, I can take 70% of that 10,000 and my partner can take 3,000. There's no issue because we're a partnership. When I become an S corporation, however, that will not fly. So again, some of these nuances need to be considered. Then we have the C corporation. The issue with that is there's what's called double taxation. So a C corporation is a totally separate entity. With the change of the Tax Cuts and Jobs Act, C corporations, there's a flat 21%. So C corporations, they used to have a progressive tax rate similar to individuals, whereby the more money you make, the more taxes you pay, right? On every dollar, essentially, once you creep into that next tax bracket. But with the change with the Tax Cuts and Jobs Act, it's a flat 21%. So it doesn't matter if the net income for the business was $1, 1,000, 10,000, a million. Everybody pays 21% across the board. The issue with that, however, is that the C corporation pays the flat 21%. When you pay dividends to the shareholders, the owners, they now need to report that dividend on their personal tax return, right? So that's one of the downsides of a C corporation, the double taxation. The corporation pays taxes on the net income, and then from there they pay, or let me not say net income, retained earnings, right? How much they have left over. And then from there, when they distribute dividends from the retained earnings, the shareholders need to pay taxes on that. So that's a downside. Then with the S corporation, generally there's single taxation, similar to a partnership. Again, the partners, they receive the 1120 SK1. The challenge with that, though, is that with an S corporation, for the most part, similar S corporation, the 1120S is an informational return, but in the event that we have what's called a built-in gains tax, that's essentially where, the S corporation, one of the shareholders, they had a property worth $100,000, and when they invested it into the S corporation, it was worth $200,000. So there's a built-in gain of $100,000 for this property that was contributed to the S corporation. Hence, there's potentially going to be a built-in gains tax. And then passive investment income tax, Uncle Sam says, hey, you know what? If this, S corporation is making too much passive income, then you could be subjected to a tax for that, right? Because there's a lot of creative ways to take advantage of the tax law. So, Uncle Sam, the IRS, the protector of the revenue generated by the government by filing taxes, what they'll basically do is put these taxes in place so that way individuals are not taking advantage of the tax law in ways that are abusive. So that's why they have these built-in gains tax and passive investment income tax. Next, we have what's called alternative minimum tax. This applies to sole proprietorships directly, partnerships indirectly, as well as S corporations is indirectly. C corporations are not subjected to AMT. Next, we have state taxation. This is also very important. I know that this is a federal, tax law course, but for the most part, you also need to figure out what's happening at the state level. You got to check out the state law on how the entities are going to be taxed. And does the state even recognize the S election? Some states do not. So that's something that you need to keep in mind. Also, does the state have specific tax on entities regardless on the income level? I am from New York City. Whether you make income or not, you're still paying $25, right? $25 is the minimum each year that an LLC needs to file. That is something to consider, right? For some states, if there's no income, then in such case, there's no tax due. But in some states, much like New York City, there's a flat minimum fee that is going to be due each year. So we move on to Unit 4, controlling the entity tax. So there's various techniques that can be used to control the tax liability, whether imposed on the entity or the owner, such as we have what's called a distribution policy, recognizing the interaction between the regular tax liability and AMT liability. So especially for those owners that are in high tax brackets, these are things that they want to think about, things that they want to figure out. Hey, I am in this high tax bracket. I'm probably going to get hit with AMT because of the amount of income that I'm generating outside of the business. This is something that they need to consider. The utilization of special allocations depending on the form of the business. Some allocations, they stay just at the business level, and some are passed through. Some are subjected to limitations. So these are some things that also need to be considered. Are there favorable tax treatments of certain fringe benefits, minimizing the double taxation, consideration of the qualified business income deduction, because that applies to not or unincorporated business entities. The qualified business income deduction, it won't apply to C corporations, right? Because that's ultimately the reason why the QBID was put into place to begin with. So next we see favorable treatment of certain fringe benefits. So ideally, a qualified fringe benefit produces the following tax consequences. So it's deductible by the entity, the employer that provides the fringe benefit, and it's excludable from the gross income of the taxpayer. The code, the Internal Revenue Code, it includes several statutory provisions that make the favorably tax fringe benefit treatment available only to employees. So whenever there's classification of an owner as a non-employee, there's two negative results. So deduction for the cost of the fringe benefit, it's may be unavailable to the entity, and an owner whose fringe benefit was paid for by the entity, they will need to include the cost of the fringe benefit in their gross income. So if I have a sole proprietorship, I cannot be an employee of the business. So that is something to keep in mind. If I am a partner in a partnership, I cannot be an employee of the partnership. The same thing for LLCs. However, when I have an S corporation, in such case, I can be considered a shareholder employee, right? Same thing applies to the C corporation. So these are things that need to be considered. So in regard to fringe benefits, these are basically goods, services, cash, or other compensation that an employer provides to an employee in addition to their regular salary and their regular wages. So some fringe benefits, they're mandatory. So like workers' compensation, let's say you're working and, God forbid you get injured. In such case, that's mandatory, as well as unemployment insurance, as well as family and medical leave. Then there are some that are standard. Individuals might take advantage of it, they might not. So this would be like health, dental, life insurance, tuition reimbursement, depending on the nature of the company. They might allow you to use the company vehicle. So these are things that, you can take advantage of. So those would be like the standard. Then you also have what's called discretionary. So benefits, they're not always offered, but they can, kind of enhance the employee satisfaction, the retention rate. So maybe they have flexible work arrangements. We live in this day and age, since COVID happened, a lot of times people, they want to know, is this a hybrid job? Can I work from home 2 to 3 days a week? Right? That's just the nature of the world that we live in. Considering COVID showed us we can get the work done from anywhere, pretty much. Just give me a laptop, just give me internet connection, and I can get the work done. Right? So those flexible work arrangements, a lot of times where I'll see job posts pop up on LinkedIn. Sometimes, some jobs they're still full time, but for the most part, they specify and state this is a hybrid position. So that would be like a flexible work arrangement. Sometimes they offer pet insurance, on-site fitness facilities. So for those of you, that will want to work out, it's like you have no excuse. As soon as you leave your job, there's a gym right there. You don't even need to pay for membership, right? They also have free meals. I remember when I used to work in corporate America, sometimes, and I guess they do it to incentivize you to get the work done and to stay late. Get the company card, you use the company card, go and buy some meals, buy some coffee, whatever it is, or commuter services. So again, you have mandatory, standard, discretionary, but the key thing is this is available to employees. So if you're that sole proprietorship, that partnership, LLC, unfortunately, fringe benefits do not apply. So that is something someone would consider. Hey, let me let me elect to be treated as an S corporation or a C corporation if you want to take advantage of those things. Next, we have minimizing double taxation. So as we discussed earlier, only income earned in a corporate form is subjected to double taxation. However, now there's a relatively low tax rate to 21%, but there's still a lot of things to consider. So several techniques available for reducing or eliminating double taxation includes making payments to shareholders that are deductible by the corporation. So what would they do? Okay, instead of issuing dividends to our shareholders, we're going to put them on payroll, right? We're going to put them on payroll. Why? Because payroll is going to be deducted as, or it is deductible by a corporation. So the second bullet point points that out. Not making distributions to the shareholders. They're not going to get a 1099 div. Making distributions that qualify for the return of capital treatment at the shareholder level. So we're going to learn in a later chapter, whenever a corporation makes a distribution, it is first treated as a return on capital, right? When they make distributions from retained earnings, it's first treated as a dividend to the extent of the retained earnings or the accumulated the earnings and profits. Then it would be treated as a return on capital, and then anything in excess of that will be treated as a capital gain. So as a corporation, you want to be strategic about when you are making these distributions. And then lastly, something they might decide to do is, yeah, we're a C corporation, but for tax purposes, we're going to make the election to be treated as an S corporation for tax purposes. Making payments to the deductible. So some deductible distributions include, as mentioned, salary payments to shareholder employees, lease payments to shareholder lessors, and interest payments to shareholder creditors. But the IRS, again, because when people will come up with really creative ways to take advantage of these things. So with that being said, what they'll typically do, the IRS, they'll scrutinize these types of transactions because it needs to be reasonable. It has to be reasonable because, again, what individuals will do is, let's say a shareholder owns a rental property. What they would do is essentially lease it to the corporation that they own, and then they would get to write it off in certain cases. So there's a lot of nuance. There's some complexity because, again, Uncle Sam knows that sometimes we ain't no good. Okay, sometimes we try to take advantage of the law, and within reason. Because again, one thing you learn with taxation, tax avoidance is not illegal. Tax evasion is. But some people, they're kind of like borderline tax avoidance and tax evasion. So that's why the IRS, they pretty much scrutinize it. It needs to be reasonable, especially as a C corporation. There needs to be proper documentation. And if you are renting the property to the corporation, it needs to be at least close to, if not fair market value. So all of these things to consider. Next, again, sometimes they just choose, we're just not going to make distributions. So double tax is avoided unless the corporation makes distribution, actual or deemed. But, see again, Uncle Sam is smart. They have to watch out for what's called the accumulated earnings tax. So let's say an individual, they're wealthy already and they have this C corporation. They don't really need the extra money, right? They don't need to take any money out of the C corporation. So I sincerely believe that a lot of tax laws are because of tax loopholes that, people try to take advantage of. So individuals, they would just accumulate a lot of earnings in the corporation for no justifiable reason. So what Uncle Sam says is, okay, so you're holding on to this money, you're keeping it in the corporation for no good reason. If you don't pay taxes on it, boom, you're gonna get hit with 20%. Within, there's like a minimum, I believe the amount is 250,000. And if there's more than 250,000 in earnings that accumulating, there needs to be a reason why you're holding on to it. Does the company plan to expand? Does the company plan to buy out another company or something like that? There should be a reason why the company is not making a distribution other than trying to minimize double taxation. Then we have the 0, the 15, 20%, the qualified dividends reduce the potential negative impact of double taxation. Next, we have return of capital distribution. So double taxation, it can also be avoided if the corporate distribution can qualify as a recovery of capital rather than a dividend. So distribution is treated as a repayment of a shareholder debt when the corporation has no earnings, no profits, no earnings and profits, referred to as EMP. And again, we'll see this in a later chapter. This qualifies as recoveries of capital. Next, we have stock redemption and liquidation. These offer another opportunity to avoid dividend treatment. The distribution, maybe it can be treated as a sale of the shareholder's stock. And although any gain on such a sale would be taxed at the same rate that it would be as a dividend, the amount of the distribution that's a recovery of capital, it would escape the current income taxation altogether, right? So I know that might be like, what? That makes no sense. So we'll put some numbers to it. Let's say that there's a distribution of $20,000. 10,000 is reflected, or 10,000 represents the dividend, and 10,000 is the recovery of capital. So rather than paying taxes on the $20,000 at the 0, 15, 20% rate, if it's qualified, if it's not, then it's basically ordinary income. But in such case that the 10,000 represents recovery of capital, only 10,000 is going to be taxed, right? The other 10,000 is just a recovery of capital. So that's basically what that means. The capital basically offsets the amount of the distribution, how much is going to be subjected to tax. As it relates to S corporation, generally it eliminates double taxation, but there are some things that need to be considered. If you are in an S corporation, it's more than one individual, everybody has to consent. It's not just a one thing, majority rules. Everyone has to consent, right? On form 2553, where you make that election, the second page, I believe it's the third page, second or third, one of them, right? They need to sign that, hey, yes, I agree for this entity to be considered or treated rather for tax purposes as an S qualification or as an S corporation. Can the qualification requirements for the S status be satisfied at the time of election? Do they have 102 shareholders? In such case, sorry, you do not qualify to be treated as an S corporation. So there are some requirements. Remember, the maximum investors, the maximum shareholders for an S corporation is 100, and they all must be U.S. citizens. So the S corporation qualification, again, a lot of times people, they just say, I just want to save money on taxes. I want to save on self-employment taxes or FICA taxes, Social Security and Medicare. They're just thinking about that 7.65%. But again, now you need to consider the maintenance requirements, not just now, but in the future. Can you continue to meet those requirements? Because again, there's a lot of administrative burden that is associated with becoming an S corporation. For what period are the conditions that make the S election beneficial? Are they going to continue to make sense? I have clients, sometimes they come in and they're an S corporation and they're struggling to pay payroll. Right. And unfortunately, if you revoke your S election, you have to wait 5 years to become an S election again. So you have to weigh the pros and the cons. It's not just, oh, hey, I'm going to save $10,000 this year. What about 5 years from now? What about 10 years from now? Is it going to make sense in the long run? And then lastly, will the corporate distribution policy create the wherewithal to pay problems at the shareholder level? So with the wherewithal to pay, again, think of it like this. Very simple example. Someone has a property, it's worth $100,000. Based on the area that they're in, the value of the home is now $300,000. Imagine Uncle Sam telling that individual that they need to pay taxes on the $200,000 because of the appreciation of value. Like, what? That doesn't make any sense. So that's simply stated the wherewithal to pay problem. Is this corporate distribution gonna create that type of problem where the individual, is gonna need to, or it'll appear as though they have income when in all reality they don't? So something to consider. Then we have the availability of the qualified business income, the QBID deduction. So again, when the corporate tax rate was changed from progressive to a flat 21% rate, not all businesses operate in the corporate structure. So for our unincorporated businesses, they put the qualified business income deduction in place to kind of offset it. So therefore, business entities that are unincorporated, they get to claim 20% of a deduction. There are some nuances, with the qualified business income deduction, but for the most part, once you don't meet certain thresholds or you're below certain thresholds, you basically get to take 20% off the top. So if you had $10,000 of net income, you get to take 20% off. So therefore, your taxability starts at 8,000, pretty much, right? That's just a very simple example. So organizing a business as flow through entity, that's a sole proprietorship, partnership, including an LLC or S corp, it potentially offers this benefit in addition to the avoidance of taxation. The qualified business income deduction, again, we just covered this, provides non-corporate taxpayers who owns businesses not taxed as C corpus as much as, because again, it could phase out depending on the situation. 20% is the max, but depending, on some of the nuances, maybe it'll be 15%, 10%. And well, the second bullet point basically just highlights what I mentioned. There are several limitations and restrictions based on a taxpayer's income as well as the nature of the business. So we now move on to Unit 5, tax consequences of organizational form choice. So generally, making contributions of cash and property to the entity in exchange for ownership interest. So generally, it's tax-free to both the entity and the owner. As it relates to C corporations, in another chapter, we're going to learn about what's called Section 351. And that is essentially where you contribute property to a corporation in exchange for stock, solely stock. So in the event that, let's say, we'll use that same example, the individual had a property, it's worth $100,000, or they paid rather, their basis in the property was $100,000 and now it's worth $300,000. When they contribute that property to the corporation, the corporation has a built-in gain. The value of the property has appreciated. But again, when you really think about it logically, the individual that owned the home also owns the corporation. So there was no real exchange ultimately. So in such case, once those Section 351 requirements are met, there's going to be no tax to the owner. Owners and entities, they take a carryover basis. So for that same individual, the $100,000 basis in the property is going to be their carryover basis when the property is now in the corporation. So they take a carryover basis in their ownership interest and in assets that have been contributed respectively. If the fair market value of the property contributed is more than the adjusted basis, they might want to make a special allocation. So this is required when we're dealing with a partnership or an LLC. This is not available to C corporation or to S corporations. Effect of basis on ownership interest for sole proprietorships, this does not apply. For partnerships and LLC, profits and losses affect the partner's basis. So profit basically means they made money, right? They had revenue of 10,000, their expenses were 5,000. That $5,000 represents profit. So as you would think, it has a positive effect on the partner's basis, and it would obviously, be allocated based on profit and loss percentages. Losses obviously have a decreasing effect. The partner's basis is also going to be increased by their share of partnership liabilities. Next, we have C corporations. The shareholders' basis, it is not impacted by the corporate profits and losses. With an S corporation, on the other hand, the shareholders' basis is increased by profits, decreased by losses, but it is not affected by corporate liability. So again, all of these things to consider. Next, we have the effect on the result of operations. So the entity concept, as we mentioned, that is basically where, totally separate. It's a separate entity, the C corporation, but the conduit perspective is where it is an extension. So the entity concept is the source of double taxation for the C corporation form. The earnings component, they lose their identity when they're passed through to shareholders in the form of dividends. So let's say the corporation had capital gains, they sold stock. When it passes through to the shareholders and they receive a dividend, it is not treated preferentially. It's basically just treated as ordinary income, right? It is dividend, of course, unless it's qualified dividends. But, for the most part, they're going to pay taxes on it. It has a separate character. They lose their identity, rather. Dividends are paid out of tax-exempt income. Excludable interest income is converted into taxable dividend because of the entity concept. So again, these are the things that you need to consider when making the decision. We have the partnership, the LLC, and the S corporation. They use the conduit concept. The business is just an extension of the owner. So with the partnership, LLC, S corporations, in the profession, we refer to these as pass-through entities or flow-through entities, because the business's income, expenses, credits, deductions, gains and losses, they flow through, they pass through to the individual owners. Distributions from partners, LLC owners, or S corporations, they're typically tax-free, but distributions from a C corporation will be treated as dividend income. If appreciated property, and we kind of mentioned this, appreciated property, the basis is 100,000, it's now worth 300,000, that's appreciated property. Depreciated property would be the basis in the property is 100,000, and now the value is 70,000. It's less. So that's the difference between appreciated and depreciated property. So whenever appreciated property is distributed to S corporation shareholders, the realized gain is going to be recognized at the corporate level, and that's the same way it is treated at the C corporation level. And the corporate level gain is going to be passed through to the S corporation shareholders. So that's where there's that, built-in gains. Next, we look at the effect on passive activity losses. For corporations, passive activity losses apply if it's a closely held corporation or if it is a personal service corporation. So the passive activity loss, they're effective for the partnership, LLC, and S corporations, but again, they apply only to these personal service corporations that are closely held. So a closely held corporation, this is basically where more than 50% of the stock at any time during a year. So even if it was just one day, right? Any time during the last half of the year is owned by 5 or less individuals. So very, very important to keep in mind. So that will be considered a closely held corporation. In such case, passive losses, they can offset the active income. So we have what's called active income, we have what's called passive income, and we have what's called portfolio income. So active income, let's say I am an hourly worker. My first job was at McDonald's, right? My first real job anyway. So let's say I'm working at McDonald's. When I show up, I clock in, and at the end of the week, I get paid. If I do not show up to McDonald's and clock in and work, I will not get paid. So that is considered active income. I need to actively work to receive that income. Passive income, we'll use McDonald's again, right? Let's say I own the building, right? Or I own the space, the plot of land. I don't, work for McDonald's, whether I'm there or not. The McDonald's that I used to work for was in Manhattan in New York City, right? I live in Queens. I can be in my house in Queens. I'm still making money because the space is there. Other people are working every, month. They're paying me. It's a it's Manhattan. So let's say the rent is maybe $30,000 a month or whatever it is, depending on the location, right? I'm just throwing out an egregious number, but right, whether I'm there or not, that would be considered passive income. The building is there. I don't need to go in to get the money. So that's an example of passive income. Real estate is the most common example of passive income. The structure is already there. There's not much I need to do. Next, we have portfolio income. So this is basically like where your money is making money for you. So you lend money and you purchase bonds, right? You have stocks in a company and things of that nature. That would essentially be considered portfolio income for the most part. So just wanted to make sure that you understand the differences between the three types of income: active, passive, and portfolio. So in such case, with these closely held corporations, the passive losses, yes, they can offset active income, but not portfolio income. Next, we have a personal service corporation. So this is where the principal activity of the corporation is the performance of personal services. The services are substantially performed by owner employees. So those that own the corporation and they also work for it. And an owner employees own more than 10% in value of the stock of the corporation. Next, we have loss limits that apply to the owners of partnerships, LLCs, and S corporations. So this is another thing that I started seeing in the profession. Before with S corporations, that was another thing, right? Because with, like, let's say in LLC and a partnership, the losses, they just flow right through to the individual, right? To some extent. With an S corporation, however, we have this new form called Form 7203. I'm not 100% sure when the form came out, but with the form, let's say the business has a loss of $30,000. If your basis in the S corporation is zero, you can take none of that loss. So that $30,000 loss, it just carries forward, carries forward, carries forward until you have income. However, let's say there's a $30,000 loss and your basis is only 10,000. The loss that can be claimed on the individual's tax return, the shareholder's tax return, is capped at whatever their basis is. So passive losses, they're separately stated items that flow through to owners, and passive loss rules, they apply at the owner level. So this is also something to keep in mind when you are starting up this corporation or this business rather, and hey, in the first few years, we're going to have losses. You don't want to be a C corporation. Why? Because the loss is going to stay at the corporate level. S corporation, if there's no basis, you're not going to get the benefit of it. You might say, hey, you know what? Let me just start off as a sole proprietorship so that way I can take advantage of the loss wholly. So these are some things, again, to keep in mind. Next, we have these at-risk rules. They apply to partnerships, LLCs, S corporations, and certainly certain closely held C corporations. The application of the at-risk rules, they can produce a harsher result for the partnership and the LLC than for the S corporation. So again, all of these things need to be considered. Next, we have the effect of special allocation. So one of the advantages of the conduit concept, where again, with the conduit concept, the business is an extension of the owner versus the entity concept, where it's treated separately, is the ability to make special allocations. Special allocations, they are not allowed for C corporations And indirectly, the corporate form, it may be able to, achieve these results. Again, payments to owners, rents, interest, things of that nature. S corporations, they're treated more like a C corporation than a partnership with respect to these special allocations. Partnerships and LLCs, they may have opportunities to use a special allocation. So maybe they have the ability to share profits and losses differently from the share in capital. So again, that was one of the challenges with the S corporation. All of the distributions, they essentially need to be in proportion to the percentage of ownerships. Partnerships, there's a bit of flexibility. Special allocation required for the built-in gain loss of contributed property. There's special allocation of any item permitted if the substantial economic effect rule is satisfied. There's an optional adjustment to basis that results from distributions. There's an optional adjustment to basis that results from acquisition by purchase, taxable exchange, or inheritance. So all of these different things to consider. We move on to Unit 6, FICA, which stands for Federal Insurance Contribution Act. This is basically, every time you get your check, right? And let's say your gross income was $1,000. Your check is probably going to be, depending on, how you fill out your W-4 and all of this other stuff, give or take maybe $700, $800. Why? In addition to your federal income taxes and in addition to your state income taxes, you also need to pay Social Security and Medicare, right? So 6.2% for Social Security. Hopefully you live long enough to receive Social Security. If not, think of that as 6.2% of your income that you essentially never see. And then Medicare taxes, which is 1.45%. And again, unless you live long enough to get Medicare, you're never going to see that back. Okay. So think of it as 7.65% of your income that is always leaving your check. And unless you live long enough, you will not see it. Self-employment taxes, this is basically the same thing. They just call it a little different. FICA taxes, that applies to employees. Self-employment taxes, same thing. It still consists of Social Security and Medicare taxes, but you are both the employee and the employer. And then we have NIIT, which is the net investment income tax. So a lot of times you'll hear individuals say they don't like, the tax law because individuals that make a lot of money, they don't get taxed a lot. Well, with that being said, individuals are subjected to what's called this additional Medicare tax and net investment income tax, which we will see a few slides from now. So payroll, employment taxes, it can be a significant cost for a business and its owners. There's a combined rate of 15.3%. So again, 7.65% for the employee, and 7.65% for the employer, because the employer has to pay a matching portion. So when you combine the two, that's how we get the 15.3%. Such costs can be classified into two categories. We have FICA taxes, again, Social Security and Medicare, and self-employment tax, which is the equivalent just for self-employed individuals who receive gross income and they are responsible for paying taxes on their own. So FICA, the Federal Insurance Contributions Act, it is imposed on the wages of employees. We already covered this. Social Security is 6.2, Medicare is 1.45%. And in addition, there's a 0.9% additional Medicare tax imposed. So when you start to make more money, right? Like Biggie Small said, more money, more problems. Once you start to make over $200,000, now you need to pay an additional 0.9% Medicare tax. If you're married filing joint, it's $250,000. And if you are married filing separate, it's half of that, which is $125,000. So this is something to, consider as an employee. Do I want to get that raise on my job or not? The more money you make, the more piece of the pie Uncle Sam wants, unfortunately. And again, this is just at the federal level. So here we see all wages of employee. They're subjected to Medicare tax. So one thing we'll see with FICA taxes, they are capped. So for 2025, the maximum amount is $176,100. So once you make more than that, you're no longer paying that 6.2% ultimately. Medicare taxes, however, you could make $1 million, $1 billion, doesn't matter. You're still paying that 1.45%. And then again, as mentioned, the employer pays one half and then the employee pays the other half. So this is something to keep in mind. Next, we have the self-employment tax. Again, this is, pretty much similar to what we just pointed out. Self-employed taxpayers, they're both the employee and the employer. But, if we think about it, you might say, wait, well, then why would I want my own business if I'm paying 15.3%? And then if I'm an employee, I only pay 7.65%. So as a self-employed individual, when you file your tax return, you do get a deduction for one half. So it basically levels it out, right? So ultimately, you're still only paying 7.65% because you get a deduction for one half. All right. And similar, it doesn't matter if you're an employee or self-employed, you're still getting hit with that additional Medicare tax if your self-employment income is in excess of that 200,000. Let's see here. Additional Medicare tax that's imposed on the taxpayer's combined wages and self-employment income. If the self-employment income is negative, there's a loss. It's treated as zero in computing the additional Medicare tax. And again, this is what I pointed out. Imagine if, self-employed individuals had to pay that whole 15.3%. I highly doubt there would be a lot of business owners, or I've spoken to some clients, and a lot of times, you'll or even, just in everyday life, when you go and let's say you book, like I, recently booked to go and get my hair done, and I was talking to the individual, and a lot of times you need to pay the booking fee using like a card, but they always say the rest of the payment must be in cash, right? And if you think about it, how can Uncle Sam track cash? They'll be able to track the deposit to the bank account, but you can't track the flow of cash. So I would assume that there would be a lot more individuals that would run businesses and take cash only because they can hide the cash. Okay. So in that case, that's why you get to deduct the one half. And just to kind of like, level out the playing field, no portion of the additional Medicare tax is deductible as a self-employed individual. So just keep that in mind. Next, we move on to the net investment income tax. So this is a 3.8% tax that applies on net investment income for individuals that make a lot of money. This also applies to trusts and estates. So with the net investment income, this is for those that, they're receiving investment income, portfolio income. So they're getting interest from bonds, they are receiving dividends from stock, as well as maybe they're receiving passive income from rents and things of that nature. They get hit with an additional 3.8% in tax. So high income, I don't know whose standards these are, but high income is if you make more than $200,000. It's not a lot of money, but according to Uncle Sam, it is. So therefore, if you have income more than that and you have, these types of investment income, unfortunately, you're going to get hit with an additional 3.8%. Net investment income tax, it doesn't apply to partnerships and S corporations, but it does apply to their owners. Pass-through entities report pertinent information to the owners, so that way they know whether or not the net investment income tax applies. All right. Next, we have the effect on an entity and its owner. So in general, wages of employees and all of their businesses, they are subjected to FICA taxes. Employee pays one half, employer pays the other half. Self-employment tax, that applies to Schedule C for a sole proprietorship. General partners guaranteed payments for their services. So, payments for services is just as though they, work for the partnership pretty much. And then in addition to their share of net earnings for the partnership, got to pay self-employment taxes on that. Limited partners guaranteed payments from the limited partnership for services rendered, but not their distributive share of the partnership earnings. So that's another thing. When you are forming this partnership, you want to keep that in mind. As a general partner, self-employment applies to the guaranteed payments for services, as well as the partner's share of net earnings. But as a limited partner, you're only subjected to self-employment taxes on the guaranteed payment for services rendered, but not the distributive share of the partnership earnings. So definitely important to keep in mind. Then with the self-employment tax, It's the net earnings of the corporation. They have no effect on the shareholder's self-employment income. The shareholder's share of net earnings of the corporation is not considered self-employment income. If the LLC owner is treated as a limited partner, the distributed share of the net earnings is not subjected to the self-employment tax. And if an LLC owner is not treated, then obviously the share is going to be subjected to self-employment taxes in addition to regular taxes. So we move on to unit 7, disposition of a business or an ownership interest. So disposing of a business can be viewed as either a sale of ownership interest or a sale of the asset. So the tax consequences in general, they're more favorable for a sale of an ownership interest. So for a sole proprietorship, the sale is treated as the sale of the business's individual assets, gains and losses. They're calculated separately for each asset with the tax treatment depending on what's the nature and what's the holding period of the asset. Is it section 1231 property? Is it section 1245, section 1250? And the reason why this is important is depreciation rules. And what about the holding period? Was it short term? Was it long term? All of these things need to be considered. And then capital assets such as investment, land, and stocks, those would qualify for the capital gain or loss treatment. Any amounts received for a covenant not to compete is treated by the seller as ordinary income. If the amount realized exceeds the sum of the fair market value of the identifiable assets, any covenant to compete, then the excess is going to be treated as goodwill. Payments for goodwill generate capital gain for the seller. Any purchase price above the value of that identifiable assets, those will be considered goodwill. And goodwill and covenants, they're amortized by the purchaser over a 15-year statutory period. So amortization, pretty much just think of it as depreciation, but for a intangible item. So tangible items, those are items rather that we can perceive with our five senses. I can see the desk, I can touch the desk, versus the value of a company. I can't see it, I can't perceive it with my five senses, but I know it has value. So that's essentially the difference between tangible and intangible. Tangible, you can perceive with your five senses. Intangible, you cannot. So for tangible goods, we depreciate. Intangible assets, rather, we amortize them. So next we have partnership and limited liability companies. If the transaction takes the form of an asset sale, then it's treated the same way as it is for a sole proprietorship. The tax consequences, they flow through to the owners of these entities. An ownership interest in a partnership or LLC, it's generally considered a capital asset. However, the benefit, it can be curtailed, it can be restricted by the need to recognize gain that's related to the appreciation of the partner's ordinary income producing assets. And then in such case, it might be treated as an ordinary gain, even on the sale of an ownership asset, ownership interest, right? So capital gains are taxed at preferential rates, 0, 15, 20%. Ordinary gains are taxed at ordinary tax rates. So if you have a gain, you would prefer for it to be treated as a capital gain for the most part. Capital losses, those are capped at $3,000 per year. If you are married filing separate, it's $1,500. Ordinary losses, however, they are fully deductible. So if you're dealing with a loss, you would want it to be an ordinary loss. So just something to keep in mind with the difference between capital gains and losses and ordinary gains and losses. They are treated differently for tax purposes. Here it states, from a buyer's perspective, the tax consequences, they're not affected by the form of the transaction when the purchaser acquires all of the interest in a partnership. In the event that the transaction is an asset purchase, the basis for the assets is going to be equal to however much they paid. If the buyer intends to continue to conduct the business, then the assets can be contributed to the entity tax-free. And the owner's basis is going to be equivalent to their purchase price for the asset. So likewise, if all the ownership interests are purchased, then the purchases is deemed to have been terminated. So it's basically like, a liquidation if they purchased all of the ownership interest. So it's as though the partnership was terminated and they distributed the assets to the former partners, who then sold the assets to the purchaser, the buyer. The purchaser's basis in the assets is going to be their purchase price, and the holding period begins the day after the purchase. Whenever a taxpayer purchases a partnership or LLC interest rather than the entire business, and so instead of, think of it like a piece of pie, right? Instead of the whole pie, I just want a slice or maybe two, maybe three. So think of it in that nature. They just want a portion of the LLC interest, not the whole business. So whenever that happens from another owner, the basis of the assets may not reflect the amount that they paid to the new owner. So in order to mitigate this problem, the entity can make an election to adjust their basis to reflect the amount that was paid by the owner. And as the basis of the assets inside the entity, they don't reflect the amount paid by the owner, the basis adjustment is allocable entirely to the new owner. So in a C corporation, the sale can be structured as either an asset sale or a stock sale. So the stock sale, it has a dual advantage for the seller because it's less complex, both as a legal transaction and as a tax transaction. In such case, double taxation is avoided because the only gain that's going to be recognized is on the sale of the stock by the shareholder. And stock sale gains is tax favored, as we know it's going to be subjected to the capital gains rules. In the event that the fair market value of the stock is more than the corporation's adjusted basis for the assets, the purchaser is going to be denied the opportunity to step up the basis to reflect the amount paid for them through the stock acquisition. And when we're dealing with an asset sale, the seller of the business can be either the corporation or it can be the shareholder. In the event that the seller is a corporation, the corporation has to sell the business, their assets, pay any debts that were not yet transferred, and they'll make what's called a liquidating distribution to the shareholders. And we'll learn about liquidating and non-liquidating distributions in future chapters. And in the event that the sellers are shareholders, the corporation will pay any debts that are not transferred, and they'll make a liquidating distribution to the shareholders and then sell the business. And regardless of whichever approach is used for the asset sale, double taxation is going to occur. It's going to be taxed on the actual sale of the assets, and it's going to be taxed as if it was sold when they make the liquidating distribution of the assets to the shareholders, who then in turn sell the assets. The shareholders, they're going to be taxed when they receive the cash or the assets distributed by the corporation. And the asset sale, it basically helps to resolve the purchaser's problem. They're not going to get to take advantage of the step up basis, right? So that's why the asset sale, kind of helps in that case. The basis for each asset is going to be equivalent to the amount that they paid for the asset. In order to operate in a corporate form, and this is assuming the purchaser is not a corporation, the purchaser that needs to transfer the property to a corporation is Section 351. So it's Section 351. This is a check the box election. And this is basically where they defer, the tax on the appreciation of value in the property. And conflict exists between the buyers and the sellers' objectives regarding the form of the transaction. So if we look at it from the perspective of the seller, they would prefer for it to be a stock sale. But if we look at it from the purchaser's perspective, they will want it to be an asset purchase. So typically what they'll do is they'll bargain to figure out, what works better. And then lastly, we have the S corporation. So the S corporation is treated similarly to the S corporation. Asset sale at the corporate level or a liquidating distribution recognizes tax at the corporate level, but double taxation is going to be avoided. So this brings us to Unit 8, converting to other entity types. So instead of disposing of a business, the owners, they can decide they want to convert. So as mentioned with an LLC, they can decide, hey, you know what? I'm making a lot of money. Instead of me, continuing to pay extra, in self-employment taxes, and it makes sense when they consider both the tax and non-tax factors, they can become an S corporation. Not become, but they can elect rather to be taxed as an S corporation or a C corporation. So does the conversion result in the recognition of a gain or loss? What is the basis for the ownership interest in a new entity form? And what is the basis of the assets of the new entity form? So these are the three primary issues that arise when they decide they want to convert the tax entity form to a different tax entity form. So with the sole proprietorship, the conversion of a sole proprietorship into another entity form, it can be achieved without any recognition of a gain or loss. So my business, I used to run it as a sole proprietorship. I didn't, set up anything. I just started my tax firm. But now that I'm an LLC, all I basically needed to do was file the paperwork with the state, and that was it. There was no tax. So this applies regardless of the new entity form. So I set it up as an LLC. If I decided to set it up as an S corporation right off the bat, or a C corporation, there would be no recognition of gain or loss at the entity or the owner level. If we have a C corporation, the conversion to the S corporation tax entity, it requires the election of the S status. C corporation. So the C corporation, they could convert to any of the following entities. So they could be a sole proprietorship if there's just one owner. They can be a partnership if there's more than one owner, LLC, S corporation. So just because you start off as a C corporation, it does not mean that you need to stay there. You can also convert or revert to another type of tax entity. Next, we have that with the C corporation, in the event that they want to convert to an S corporation tax entity, they need to do the election on Form 2553. But the election of the S corporation produces the following tax consequences. There's no recognition of gain or loss. There's going to be a carryover basis for the shareholder stock and a carryover basis for the assets of the corporation. Whenever the corporation decides to convert to a partnership and LLC, the corporation needs to be liquidated. So in such case, they are going to recognize a gain or loss at the corporate level, at the shareholder level, and the fair market value basis for the assets are going to be distributed in a liquidation. Next, we have the partnership or LLC. So with the partnership or LLC, they can elect to be treated as a C corporation or an S corporation. Why not a sole proprietorship? A sole proprietorship is one individual, so that will not apply. For the LLC, as we know, it could be single member or it can be multi-member. So with the partnership or LLC, the partners, they can transfer their partnership interest to a corporation in exchange for the stock. This would satisfy the control requirements. And assuming that Section 351 requirements are satisfied, the basis of the stock is going to be the carryover basis. The basis of the assets to the corporation is going to be the carryover basis. So we move on to Unit 9, the overall comparison of the forms of doing business. So again, this is where you provide the most value, or can rather provide the most value to a startup business. They want to know, what is the best structure, the best form for me to choose as I, start this business. And let's say that they've already made the decision. You can assist them with walking them through the pros and the cons. So that way they can know, hey, I'm currently an LLC, but it'll make more sense based on my situation and my goals to be taxed as a C corporation or maybe an S corporation, right? It's not one size fits all. So once you have a conversation with the client, you get a better idea of, what their net income is like, what their cash flow is like, what their goals and objectives are. Then you're in a better position to essentially advise them. So with the sole proprietorship, the maximum number of owners is 1. The maximum rate is 37%. Why? Because obviously we have 7 tax brackets based on our progressive tax rate for individuals, and the tax is paid by the owner. Partnership, maximum number of owners, they need to be at least 2. The maximum tax rate is 37%. Why? Because the partners, again, it's based on their individual tax situation. For an S corporation, as we pointed out, the maximum number of owners is 100. It could be individuals, it could be estates, and some trusts only. But again, as it relates to the individuals, they need to be U.S. residents, and the maximum percent is 37. Again, the tax is paid by the shareholder. But in the event that they have a built-in gains tax or passive investment income tax, then it would be paid at the corporate level. Corporations, there's no limit. Some states require at least 2 owners, depending on the state. The maximum tax rate is 21%. And then at the corporate level, plus 0, 15, 20% on qualifying distributions to the shareholders when they receive dividends. The tax is paid by the corporation first. that flat 21%, and then by the owners when they receive the distribution, the corporation issues a 1099 div to them, and then they need to report the dividends on their tax return. As it relates to the tax year allowed, sole proprietorships follows the normal calendar year, January 1st to December 31st. For a partnership, it's based on the majority or principal partners. They can use what's called an aggregate deferral year. Next, we consider the timing of taxation. Falls within, January, December, the calendar year. The end of partnership tax year. And again, in certain situations with the partnership, it's based on a majority or the principal partners. There's no income allocation for a sole proprietorship. It's just one person. It's no need. Partnership is based on a profit loss ratio, and there's some special allocations that are allowed. For an S corporation, calendar year or a fiscal year that meets the business purpose. So a calendar year is January 1st to December 31st. I once had a student that I will forever shout out, Jacob, who gave me a better way to consider a fiscal year, right? Or to explain a fiscal year. A fiscal year is any other 12-month period. So one time I was teaching it in Principles of Accounting 1, and he said, wait, is that like a birthday? And I was like, wow, I've never thought of that. Genius. So shout outs to Jacob, right? So my birthday falls on July 19th. Every July 19th that comes, I am now a year older. So that is my fiscal year. So calendar year, January 1st to December 31st. A fiscal year is any other 12-month period. Some corporations, for business purposes, they don't want to use the calendar year. So just keep that in mind. C corporations, there's generally no restriction for, whether they need to use a calendar year or fiscal year. The timing of taxation, the end of year, for the corporation. And then for the corporation, they report it at whatever their year end is. But for the shareholders, they report it based on whatever the dividends have been received. Next, we look at the contribution of property to the entity. For a sole proprietorship, not taxable. Partnership, generally not taxable. For the sole proprietorship, they retain the source characteristics. For a partnership, it retains the source of the characteristic. For an S corporation and C corporation, it is taxable unless it meets Section 351. Next, we have loss allocation to owners. For a sole proprietorship, it's not applicable. The amount invested plus the liabilities of the business, that represents the limitation on loss. For the partnership, the loss is allocated based on the profit and loss sharing ratios, and the limitation on loss deductible by the owners is based on the partner's investment plus their share of partnership liabilities. For S corporations, it's based on the share per day, the shareholder's investment plus loans from the shareholder. For a C corporation, unfortunately, any losses at the C corporation level, it does not pass through to the shareholders. At-risk rules, they apply at the owner, partner, shareholder level for sole proprietorships, partnerships, and S corporation. C corporations, yes, they apply for closely held corporations, and there's an indefinite carryover of the excess losses. Capital gains for sole proprietorships, 0, 15, 20%. But as we know with capital losses, it's a maximum of 3,000. For a partnership and S corporations, both the capital gains and capital losses are treated the same. C corporations, still taxed at 21%. So, if a corporation sells stock, they don't get that preferential 0, 15, 20, still taxed at 21%. The difference with C corporations is for capital losses is carried back 3 years and 5 years, and their capital gains, or capital losses rather, can only be offset by capital losses. Then we have consequences of earnings retained by owners and the treatment of non-liquidating distributions. So for sole proprietorships, tax when earned, it increases the investment, and the non-liquidating distributions are not taxable. It's the same for a partnership, and it's not taxable in a partnership unless the cash or the liability relief exceeds the partner's basis. So in such case, they would recognize a capital gain. For an S corporation, it's the same as a sole proprietorship, and the treatment of non-liquidating distributions, they're generally not taxable unless the distribution is more than the AAA, the accumulated the accumulated amount or their stock basis, and it may be a dividend if there's earnings and profits from the sub C year. And it's taxed in a year received up to accumulated earnings and profits if that is more than the stock basis. And then lastly, we just wrap up with what we just covered about the sale of ownership interest. So sole proprietorship treated as a sale of each asset. The gain character depends on the asset nature. What kind of property did we sell? Partnership is treated as a sale of underlying ordinary income assets. The remainder is treating as a sale of the partnership interest and the capital gain. If we're dealing with an S corporation or C corporation, it's treated as a sale of corporate stock. The loss may be ordinary if Section 1244 applies. Otherwise, it's going to be treated as capital. So it's Section 1244, which we will learn in another chapter. As we know, capital losses are typically limited to $3,000, but if it qualifies as Section 1244 stock, you can claim an ordinary loss of up to $50,000 on the capital loss if you are single, and up to $100,000 if you are married, but that's only if it's Section 1244 stock. Next, if fringe benefits are available to owners. For a sole proprietorship and partnership, no. For an S corporation, some if there are less than 2% owner. For a C corporation, it is available but it's limited by any anti-discrimination rules, so it can't only apply to the high income earners in the business. And then we have Section 1244. Section 1244 only applies to S corporations and C corporations. And then the built-in gains only has an impact for S corporations. For our Section 1231 gains and losses, for a sole proprietorship, it is taxable or it's deductible by the owner. And there is a 5-year look-back rule. For partnerships and S corporations, it's the conduit. Again, it's the same as the sole proprietorship. The partnership and S corporation is just an extension of the business. And the C corporation, it's taxable and deductible at the corporate level. And there is that 5-year corporate look back rule, and it's available only at the corporate level. AMT, it applies at the owner level, 26 or 28%. For the partnership and S corporation, it applies at the partner or shareholder level. And as it relates to the tax preference items, it's determined based on the owner level, and then the conduit entity preferences they pass through to their owners for the partnership and S corporation. For a C corporation, AMT does not apply, but only to like very large corporations. And corporate AMT is based on financial reporting, which is governed by GAAP, generally acceptable accounting principles, rather than specific preferences and adjustments. So that brings us to the end of chapter 12, comparative forms of doing business. So again, there was a lot covered in this chapter, but as mentioned, this is an area where you can provide value to clients, helping them make that decision on which form of structure they should choose, which form of business rather, when they are initially starting the business, or even after, the business has been in existence for a while. Things change, so, maybe they need to change the tax structure. So now that this lesson has ended, you should have learned how to identify the principal legal and tax forms for conducting a business. So we know we have sole proprietorships, partnerships, LLCs, both single and multi-member LLCs. We have S corporations and C corporations. We also explained the relevance of non-tax factors in making business entity decisions, because it's not always about saving money, right? Sometimes it might just be extra administrative burden. Those things also need to be considered, as well as regulations by the government. We distinguish between the forms for conducting a business according to whether they are subject to single or double taxation. We identify techniques for avoiding double taxation and for controlling the entity tax. We identify the influence of the conduit and the entity approaches on the tax consequence of an entity's operations and the effect on the owners. We analyze the effect of the disposition of a business on the owners and the entity for each of the business entity forms. And lastly, we also learned to compare the key tax rules for the various forms of doing business. So again, this brings us to the end of chapter 12, comparative forms of doing business.